All right, we've all heard it's normal to put 20% down when you're buying a house. Well, in this video, I show you why that is effectively a myth and why you don't need anything close to 20% when you're buying a house. Here in the United States, the average first-time home buyer only puts down 6%. And when you're looking at all home buyers in general, they only put down an average of 11%. Truth be told, the average American just doesn't have enough money to put down 20%. It's either that or they choose not to put 20% down. They choose to invest their money somewhere else. So why 20%? Why is that the magic number? Well, that's the number that lenders use to determine whether or not you have to pay mortgage insurance. Mortgage insurance is basically a policy that pays lenders and banks for losses due to loan defaults. It's a way for them to mitigate their risks. And these risks get higher and higher the lower that you're putting down as a down payment. So let's say that for a $500,000 home, you are putting down $100,000. That equates to 20% down payment. This leaves you with a mortgage that is considered 80% LTV, loan to value. That is, you are borrowing 80% of the value of the home. Now let's say for that same $500,000 home, you're putting just $50,000 down. That equates to a down payment of 10%. And in terms of the LTV, that's gonna be 90%. So the lower the down payment, the higher the LTV. The higher the LTV, the more risky that loan is because they're letting you borrow a bigger and more significant portion of the home's value. It definitely sucks in tons of parts of the country because these houses are so expensive and it's just so hard to come up with 20% down. And lots of people therefore are like, dang, I can't afford to buy a home because I can't get that 20%, right? Like, I don't want to pay mortgage insurance. However, don't listen to that. Don't think that you need 20% down in order to buy a home because there are so many loan programs out there that let you buy homes with much less than 20% down. And like I said before, most people aren't putting down 20%. So don't feel like you are one of those few people that can't afford to put 20% down. It's so common here in the United States. So now I'm gonna overview some of the great loan programs out there that let you put down under 20%. The first one is the FHA loan. This is a loan that's issued by a FHA approved lender and it's insured by the Federal Housing Administration. FHA loans let you pay as low as 3.5% down. And that's why it's so popular among first-time home buyers. It really lets you get into a home with not a lot saved up. Now, what I like to tell people looking for loans, especially FHA loans, is the lower your credit score, the more likely that an FHA loan is your best bet. This is because if you want to put down 3.5% for an FHA loan, you only need a credit score of at least 580. And let's say you want to put down 10% using an FHA loan, then your credit score only needs to be about 500. Those are considered pretty low scores, so that's why it's such a good first-time homebuyers loan program, because you know lots of first-time homebuyers might not have a good of a score as someone that's already purchased a home. The downside is that there is an upfront mortgage insurance premium of 1.75% of the loan amount. Generally, this is rolled into the value of the loan. So let's say you are getting a $100,000 loan, just to keep it simple. Your upfront mortgage insurance premium is gonna be $1,750. And that can get rolled into the $100,000 loan. So your total loan now becomes $101,750. Now, in addition to this upfront mortgage insurance premium, there's also an annual mortgage insurance premium. This is going to range from about 0.45% to 1.05% of the loan amount. If your credit score is really high, you'll be paying on the lower end of that spectrum. And if your credit score is a bit lower, then you'll be paying on the higher end of that spectrum. An awesome perk about the FHA loan is that they allow you to use gift funds from relatives or family members. So the next really popular loan that people can get and put down less than 20% is actually the conventional loan. And many people actually don't know that they can put under 20% down for a conventional loan, but it's actually extremely common. So with a conventional loan, you can actually put as low as 3% down. Conventional loans are backed by Fannie Mae and Freddie Mac. And these two agencies, they solely exist to help banks and lenders give out mortgages. They actually don't offer any type of insurance for these mortgage lenders. So that leaves this insurance up to the private mortgage insurance companies out there. So whenever you're putting less than 20% down using a conventional loan, they're gonna require that you pay PMI, this private mortgage insurance. Just like the mortgage insurance premium that is associated with the FHA loan, this PMI payment is to offset the risk that these lenders are taking on by lending you over 80% of the loan to value. The amount of PMI you pay is also based on your credit score. So the higher credit score, let's say you're above a 740, which puts you in the pretty much highest bracket for loans, that's gonna give you about a PMI payment of 0.45. And then say you're all the way at the bottom at a 620, which is the minimum credit score that's needed for a conventional loan. In that case, your PMI payment is going to be much higher at about 2.25%. So you can really see why it's so critical to have the highest credit score you can have. When you're trying to buy a house and you are shopping loans, getting interest rates, well, the higher your credit score, the lower your interest rate's going to be. And the lower your credit score, the higher your interest payments are going to be. The difference between 0.55 and 2.25% is huge. So let's say that you're buying a place and you're borrowing $500,000. Let's say that you have the best credit score available, so your PMI payment is only 0.55%. That's gonna mean that you're paying about $230 per month for PMI. That's actually not too bad, right? Like, that's only about $2,700 per year, which in the grand scheme of things is not bad at all. Especially when you're comparing the rate of appreciation in most parts of the world. Like, if that's high and you're waiting to buy a house just so that you can build up that down payment, it's not gonna make any sense because you could just be paying a few $1,000s more per year right now rather than waiting it out, having house prices increase drastically and being able to afford homes less and less and less. One great thing about the conventional loan is that there's no upfront mortgage insurance payment. So there's not that 1.75% upfront mortgage insurance premium that FHA loans have. So that's why I recommend for most people with high credit scores, with high incomes, they actually just spring for a conventional loan. Another benefit of conventional loans is that you can get rid of your PMI payments once you reach 80% LTV or lower. Once you get to that point, once you built up 20% equity in the home, you can do an appraisal through your lender, and if it shows that you do have 20% equity, they'll take off that PMI payment instantly. So no, you won't ever have PMI for the entire 30-year or 15-year course of the mortgage. Once you reach 20% equity, you can just get rid of that pretty easily. And another really great loan that lets you put down less than 20% is the VA loan. And the VA loan is reserved for veterans and service members and their families. This is a true 0% down loan that you can get. And the rates are pretty low, which makes it one of the best, if not best, loan programs out there. It's really a way of the government saying, hey, we appreciate your service. Let us help you buy a house for as low a down payment as possible. There is no PMI payment, no mortgage insurance for a VA loan, but the thing with the VA loans is that there's a funding fee of 2.15%, and that is going to be rolled into the overall loan. So basically that means you don't need to pay it up front, it's just rolled into your loan and you pay it off monthly throughout the course of the mortgage. These loans are issued by VA approved lenders and they're backed by the US Department of Veteran Affairs. In fact, I'm actually helping a family buy a home with a VA loan right now. It's just really crazy to see that they can get into a home worth about $700,000 with 0% down. So this VA loan greatly streamlined their ability to buy a home, being how young they are, because they didn't have to spend many years building up that down payment. As long as their income satisfies the debt to income ratios, as long as they're making enough to comfortably afford that mortgage payment, they can jump into a home purchase without anything down. So there are tons of other loans out there. I only named a few, but these are some of the most popular ways to get into a home for under 20% down. If you think that you can't get into a house, if you can't buy a house right now, just because you don't have that so-called 20% magic number down payment, then I really urge you guys to take a look at some of these other loan programs that are extremely popular. There's no shame to not put down 20%. If you're waiting on a home purchase just because you don't have that 20% down, I think that's a mistake for the most part. Look at it this way. Say you're living in a place where the appreciation on average is about 3% per year. If you're trying to buy a $500,000 home, that means that next year, this home is gonna be worth $515,000. So $15,000 more. Are you going to want to pay that $15,000 more in a year? Or are you gonna rather prefer paying maybe a few $1,000s of mortgage insurance per year right now in order to get into the house right now? You know, financially, it makes more sense in many scenarios to buy the home with less than 20% down rather than waiting and seeing the prices of homes increase. You gotta think of it this way. Mortgage insurance isn't a punishment for not having 20% down. It's not a punishment towards you, the borrower. Instead, it's a tool that lets these lenders lend out money to people that don't have that 20%. It just lessens their risk and allows them to be able to loan money to people that don't have that full 20% down. And 20% is just some random number they came up with. There's no backing or anything. There's no actual reason why it's 20%. They were just hey, 20% is pretty good amount of equity in a home, so we're gonna use that as the magic number. And it's a win for the consumer too, because it allows them to buy a home much sooner than if they were to put 20% down. If there were no loan programs out there that accepted mortgage insurance, then so many people in the United States wouldn't be able to afford a house. The housing market would collapse. I don't even know what would happen. But yeah, I just wanted to let you guys know that you don't need 20% down to buy a house. All these loan programs out there exist specifically to get people like you and I who don't have the 20% down needed to buy a house. All right, that's all I have for today. Thanks for watching this video, you guys. If you learned something from it, I would love it if you hit that like button. And then also subscribe to my channel if you want to see more videos about real estate, about entrepreneurship, personal finance. I make videos about this every week and post them to my channel. All right, I'll see you guys in the next video.